willing to extend transition period. May faces backlash over possible extension. Not enough progress. EU leaders cancel the November summit. Her deal or no deal? Dominic Raab seeks to scupper MP's vote. And treading water, the pound holds its ground against the euro. Hello, you're watching IGTV in the IG Forex chat, where we put your questions to the experts. Today's show will focus on Brexit and how the current negotiations are influencing the Forex market. And joining me in the studio to discuss to answer your questions tonight are Simon French, Chief Economist at Panmure Gordon, and also Nicholas Cawley, Analyst at DailyFX. Thanks very much for joining us. Now, as I said, our experts are here to help you understand and trade these markets and answer your questions. We are currently streaming across IG.com, IG Trading Platform, YouTube, Twitter, and indeed Facebook. So do join the debate. Send your questions directly to our experts. You can use the hashtag IGForexChat. You can use that on Twitter, on Facebook, the IG community, or put them in the comments on YouTube as well. So while you compose those questions for our guests, let's hear on how we got to this point in time with Jeremy Naylor.
Tears, resignations and the Dancing Queen. The lead up to Brexit has had it all. It began on the 23rd of June 2016 when Britain voted to leave the European Union and Prime Minister David Cameron stood down. 1 year and 3 days later, formal Brexit negotiations between the UK and the EU began. And not surprisingly, it hasn't been easy. July of 2018, the Brexit Minister David Davis resigned, saying Theresa May had given away too much too easily. Negotiations also haven't been helped by the fact that the UK was divided. England and Wales had voted for Brexit, while Northern Ireland and Scotland were Remainers. This was reflected in negotiations over the Northern Ireland border, a major challenge at the meeting of EU leaders in Salzburg in September. Meanwhile, Scotland's First Minister Nicola Sturgeon continues to campaign for what she calls a common-sense Brexit and continued membership of the single market. So, what's been agreed? Well, at the beginning of October, the EU's chief Brexit negotiator, Michel Barnier, said that 85% of the deal was done. That includes things on how much the UK owes the EU, what happens to EU citizens in the UK and UK citizens in the EU, but there's still a long way to go. Also agreed a 21-month transition period during which Britain would negotiate a trade deal to take effect at the end of 2020. The transition period will also give companies time to adapt to the new trade rules. But if there's a hard Brexit, then there will be no transition period. So what has to be done to ensure that doesn't happen? There'll be another EU meeting later this year to iron out the details. Those details then need to be agreed on by the EU and the UK Parliament before the deadline at 11 p.m. on the 29th of March.
So the deadline comes ever closer, and today and yesterday's summit was meant to be the moment of truth summit. Instead, it seems to be the kick the can down the road summit. Saying that, though, both Tusk and Juncker have said we are much closer and they're more confident that we are getting there, but they've cancelled the November one. So before we get to the FX side of things, where do you think we stand in terms of how close we are to a deal?
So I still think we get a deal in the fourth quarter of the year. It looks unlikely now the middle of November. It looks more likely the European Council in the middle of December. Anybody who studies the history of EU negotiations know that these things invariably go down to the wire. It may even slip into January. I mean, I wouldn't hold too much hope on if it's been scheduled, but there's an opportunity to do it later and you have a more protracted negotiation. We've shown from that history that it invariably moves to the right.
Nick, where are you in terms of the deal and where we are? I'm
not as positive as I was a few weeks ago. Everything that we get out of these meetings is kind of the same. You know, as we said earlier, 85% done, and it's just, you know. But it always seems to be the EU are turning around to the UK and saying that's not right. Go back and fix it, and then come back to us. And I think as Simon says, I mean, there will come a stage where you get this, you know, kind of face-off, and one side will kind of have to say, well, okay, we'll move and we'll make something happen. But at the moment, I mean, there's nothing, from saying a trading point of view, a market's point of view, there's nothing that's saying, you know, you should be buying sterling because something's going to happen. It
was quite funny because in that package, Jeremy talked about the fact that 85% agreed and they included the amount owed. But actually, if the transition period extends, that could change. Then we said the agreed was the transition period, yet the conversation today was all around the transition period. So it's kind of like 2 steps forward, 1 step back, or is it 1 step forward, 2 steps back? I'm not quite sure at the moment.
Well, let's be clear, it's the easiest 85% that has been agreed. It's the hardest 15% that hasn't been agreed. And you're right that the timing on the transition, the nature of the backstop agreement, and also the political calculus. One thing we haven't yet mentioned is that the European Union needs to calculate how much they can give without it being perceived within the 27 remaining states that the UK has managed to leave easily and without pain. But equally, they don't want to push that too far because, of course, that might be too much that Theresa May can sell back to the UK Parliament, can't get a deal, and therefore you get an accidental no-deal Brexit. So there's some delicate calculus to go alongside the various financial and economic incentives that sit towards making a deal.
And that's the problem when you're looking to trade this, isn't it? Because there are so many factors involved that how do you find your way in this when you're looking to trade it?
Well, so in the short run, you have to recognise that as a quantum, trade between the UK and the EU makes up about 13% of UK GDP. It makes up about 2.4% of Eurozone GDP. That tells you that although they run a trade surplus with us, and that would be suggest that the Eurozone has to make concessions, the reality is it's not as material to the overall size of the economy. And what we have seen, Jeremy's package talks about the chronology of this, through the chronology, and David Davis resigned as a result of it, the ex-Brexit minister, because it's had to be the UK that's had to make concessions to move negotiations forward, and we remain in that space. And I think as we move through the next couple of weeks, couple of months, you'll have to see the UK give a bit more ground in order to secure that final deal so we don't have a cliff edge on the 29th of March 2019.
So what does that then do for the pound? Let's go through some other scenarios. Let's go through, you feel you're not as confident, but we will have a deal. Both of you say we will have a deal. Obviously that's better for the pound. So what level should we be looking for there?
At the moment, I see no reason to buy the pound. I mean, I see, people say, oh, there may be a rebound when we get some announcement made. But I think, as Simon said, perhaps it's not until maybe the December meeting that we're going to get an announcement, a potential announcement. But then Theresa May's got to sell it back to the Conservatives, got to send it back to Parliament. And everything's so fractious there. I doubt if that's not going to be an easy process. So I think that all the pressure on sterling is on the downside. There's no reason to hold sterling assets as a trading vehicle. We were talking off air earlier, and I can see the lows which came in around 126.60 on cable. I can see those being tested again, especially when you've got a very strong US dollar at the moment, and it looks like it's going to carry on strengthening.
I think you were calling 125 for the end of the year, earlier in the year. Are you still standing by that as well?
Still standing by that. It's been a rocky road to get there. We've gone up to 143 earlier in Q1 and then retraced downwards. I think we get a little bit of an interesting pattern in Q4, what I call the inverse hockey stick. So when a deal gets announced, so short this market is of sterling that a bounce up to 135, maybe even a little bit above, is not unreasonable. But then investors will have to ask themselves, what actually has been agreed in a substantive sense on the new trading relationship between the UK and the EU? Well, absolutely nothing. And what will subsequently happen, probably not until Q3 2019, once a new Commission President is in place and the European parliamentary elections have taken place, you'll start a negotiation between the UK and the EU, and only then will you get colour as to what the new relationship will look like, how much friction there is, and what the true value for sterling is. So I tend to agree the downward trajectory is the long-term play, but you may have to go through a bit of a bounce, a bit of short covering in Q4 when there's enthusiasm that something had been agreed.
Just to assert any concerns that any technical analysts out there who hadn't heard of a reverse hockey stick, it's not a technical term, is it? It's
not. It's very much my own term. Economists use it in the context of trade, but it's not a Forex definition. But I think a visualization, if you think of turning a hockey stick upside down, it gives you an indication that the near-term bounce is not instructive as to what will happen subsequently when I guess in the cold light of day, we look at what has been determined determined in a withdrawal agreement. Not a lot.
One of the number of questions are about the outcomes. One kind of sums it up here. It says, what are the scenarios from here that could lift the pound and which will more likely sink it?
I think to lift the pound, you have to solve the Irish border problem. I think that automatically lifts the pound. And if you get it through Parliament, that gives the pound a huge boost. But I think in the short term, and the only way you can lift the pound is if Theresa May shows some leadership, which has been very lacking at the moment. And I think that's weighing on the pound. You know, and I think those are the only two. There's the only two reasons for investors to come back in, to put sterling back into the market. Apart from that.
We have been focusing on the politicians thus far in this show, but I think also when you're looking at the pound, you have to think about central bankers, and specifically Mark Carney and the MPC at the Bank of England. If you're looking to make the bull case for sterling, it's not just a case of short covering or a political breakthrough, but what does the Bank of England signal regarding its next rate hike? Inflation is running 2.4%, so above the 2% target. There is potentially more inflation in the pipeline because of higher energy costs. Will the Bank of England be more hawkish early in November when it has its next inflation report and signal we may get a rate hike as early as maybe February or more realistic May 2019? If that happens, then of course investors have to look at the fact that the ECB isn't going anywhere with its rate policy. The Fed, there's question marks whether President Trump wants the Fed to go at a slower rate. If the Bank of England starts to tick out some rate increases, then that may be, it's not my base case, it may be one of the reasons to buy into sterling.
Yeah, we had a couple of questions about that. Should we expect rate hikes from the Bank of England? What will be the terminal rate of the Bank of England in this cycle? And I mean, Mark Carney, I think this was one of his quotes, he said, there are a variety of scenarios that can happen with Brexit, but in many of these scenarios, interest rates should be at least at these levels, and so this decision is consistent with that, which kind of says that he's happy no matter what happens of where he is.
Yeah, I mean, there's no reason for him to push rates up at the moment. Okay, you're saying about inflation, and we've got had some decent sort of wage growth numbers. But at the moment, if we do have this very unlikely event of a hard Brexit, you know, you cannot put rates up at them. You know, you just cannot. And I think there's enough flexibility. The Bank of England's got enough flexibility. The timing of the sort of Super Thursday meetings and the QIR reports, sort of in February and in May, you've got that lag to May, definitely. Nothing's going to happen till then. And then probably the Bank of England may start, you know, giving some signals, may start sort of showing some signs for the next QIR sort of 3 months later. But I really can't see sterling. I can't see any interest rate hikes until at least Q3. You
mentioned the hard Brexit, the cliff edge scenarios. People talk about it. One of the questions is, what is the implication on interest rates? But it's also implication on the pound. We talked about the soft Brexit and the deal. If we have no deal, we get to the end of March and there is no deal, what does that do to where we are in the pants?
Well, it's a real bind for the Bank of England. Becomes a very difficult policy environment because the near-term impact would be inflationary in terms of a weaker sterling making imports more expensive. There's an inflationary problem at a rate that is already running above 2% above the target. So that should normally, in normal circumstances, lead to the Bank of England being more hawkish on interest rates. But if they have a problem, the demand is also weak in an environment where business investment doesn't rebound, net exports doesn't rebound, consumers may be more cautious, then of course you've got that pushing in the opposite direction. And in that environment, I think what we've seen from Mark Carney, both at the Bank of Canada and his tenure at the Bank of England, he's going to err on the side of caution, which may mean either interest rates remain where they are for a protracted period, or even that we start talking about taking them back towards 0.5%, and we talk about, you know, potential restarting of QE. That's not my base case, but I don't think your viewers should really dismiss that, because it is one of the plausible outcomes in a hard Brexit where the economic response is quite significant.
But okay, we get to, will a hard Brexit already been priced in by the end of March, do you feel? If we get to that point where there's still no deal, what is it already priced into pound? What happens to sterling? What happens to cable at the end of March when we
I think pretty much it will be, yeah. I think because of the timing that we have, and you know, the 31st of March 2019 as the end date, you can't get too close to that end date and then just suddenly pull a rabbit out of the hat and say, oh, well, you know, suddenly we've done this. You know, it's not going to work. I mean, there'll be clear signals. I think at the December meeting, if nothing is going to happen, there will be clear signals.
Yeah, so I think we get to a point, I think it's the 21st of January, where the UK Parliament starts to become relevant, because such as the amendments put into the UK Parliament's withdrawal bill, the legal basis on which the UK leaves, if the government hasn't brokered some sort of arrangement, then Parliament has this meaningful vote. And what composition is that meaningful vote? Does it ask the government to go back to the negotiating table, try and extend Article 50? Your question as to whether sterling can possibly fully price in a hard Brexit, we may be well into January, well into February. You know, many, again, going back to the comments at the top of the show, there are scenarios where this stuff is done at midnight, after midnight, right to the deadline. I can't see an environment where sterling can factor all that in and be fairly priced on a hard Brexit until pretty much midnight on the 29th of March.
One of our viewers watching on YouTube is actually saying, how far could pound fall against the dollar if there's no deal, and how far could it fall against the euro?
Well, I'll leave the technical analysis to my much more learned expert, but I look at historical analysis, and you look at the big devaluations we've seen in sterling, peak to trough, when you had the IMF bailout of the UK in the 1970s, ERM in 92, Lehman's, Northern Rock, 2007-8. They were pretty much in the 20 to 25% peak to trough declines. Do I think hard Brexit is any more material than those big economic events? I don't. And therefore, 20-25% peak to trough, low, it's top teens, so 118, 119 feels like that threshold beyond which the Bank of England has to come back to the table because it's a big inflationary problem. But also the export performance starts to pick up even with potential trade barriers, and therefore there's a self-correcting element. So for me, it's the top teens against on dollars.
So what credence do we give to those who say, I think last time, the first IG Forex chat we had, someone was saying parity for euro?
No, I don't think it will get to parity. I think it's Simon's absolutely right there. We saw a spike low, I think it was beginning of the year or something. Now, some commentary came out overnight in Asia, and I think it's from the French president, and it kicked sterling down, and there was a spike down to around the 115, 117 level, something along those lines.
A bit of a flash crash, wasn't it?
Exactly, and then it quickly recovered. We don't know what really drove that, it was algos or whatever, but I don't think you'll see those levels. Low teens, 120, around those levels. And as Simon said, but there'll also be buyers. There'll also be people who will come in and say, on a longer term basis, sterling looks good here. Sterling looks attractive. And it could be for a lot of reasons. They may want to buy a UK company. They become cheap. They want to buy property over here. You know, there's a myriad of reasons when sterling becomes really devalued to buy it.
We'll get to the companies in just a moment, because that's an interesting point as well. But one of the questions is, which is the best GBP cross to be watching around all of this? We've talked about dollar, we've talked about euro. There are other crosses as well. I mean, which for you is the cross we should be watching?
Well, I know the big liquidity is in sterling dollar, but sterling euro tells you a bit more of a pure story, and for the reason being that the Fed is another part of the trade when you look at dollar. But with euro, you're looking at more trying to value the impacts on the Eurozone economy and the UK economy. So it's a more of a pure Brexit cross rate, and for that reason, I think it sees more volatility coming into March than necessarily dollar, because there could be things going on in the Fed with the Trump agenda, the China face-off. There's a series of other US-centric stories that could move that far away from what the pure Brexit story would lead you naturally to conclude that dollar-sterling cross rate.
I mean, we do have still things happening in Europe. We've got Italy weighing on it as well, the politics there. So you do have other things there, but not as much, you're saying, as would impact other crosses.
Yeah, I know, Simon's right. I mean, you can see that the kind of enthusiasm and the positive sentiment that we've had in the last few weeks that something's going to happen, that a deal's going to be brokered, or at least we're going to get some positive news. And if you look at euro sterling, it's been kind of sort of drifting down from around the 0.91 level down to about 0.87, and it's come down in a nice gradual channel. You know, it's been relatively easy to trade or to look at. And so I think, I mean, it is probably the best barometer of the whole between the
and
two.
another cross, not as liquid obviously, but sterling Swissy is one to look at as well, because of course if we get a hard Brexit scenario, that has contagion risks across the world, because they're thinking, well, there is a localized economic issue that has implications for Europe, for the broader global trading system. And in that environment, Swissy is a safe haven, has been traditionally a safe haven, and has the flip side of the euro relationship that is very well entrenched there. So I think that's also a really interesting cross in terms of a really real strong strengthening on the Swissy side of that cross.
Back at the top of the show, we talked about transition period. And did she actually say there wasn't one, or did she say that they were considering one, but it was an option, but it wasn't an option, and there will be extension? I'm not quite sure. I got completely lost, I have to say. I think a lot of people did, if you look at Twitter as well. One of the questions is, how do you see Brexit impacting the pound during that transition period, whether it's 21 months or longer, or what do we see after Brexit?
So if we have an extension, an extension of this transition period, I think that if that's announced and it gets through Parliament, I think that will weaken sterling. Initially anyhow, and then you may see businesses turning around and saying, well, actually we needed that time, we need that time to get everything in a house in order, or to make arrangements to leave.
I'm slightly more bullish during transition, because incrementally through transition, once you start the negotiation, what a new free trade arrangement looks like, be it Canada plus, be it, you know, I don't want to get into much of the jargon, but you start to get more questions are answered about what material barriers there are to trade. And what we do know is there's a lot of investment, both investment in equities, but also investment in physical UK assets that is waiting on the wings, waiting for a little bit more clarity. It doesn't need perfect clarity. You never get perfect clarity in these markets, but a little bit more on the materiality of what trade barriers may look like going forward. And therefore, as you go through transition and that treaty text starts to be established, more and more money will start to come in that has been waiting in the wings for the kind of clarity you need to do to price this stuff correctly.
And you talk about the companies and what we're seeing. It goes back again to what you were saying, Nick, as well, because one of the questions has been about companies and headquarters and where they're going to be. A lot of companies looking at perhaps moving their headquarters out of the UK. Panasonic saying it relocates its headquarters to Amsterdam in October. That decision driven by fear of potential changes in tax, also flow of goods and people. We've had several other Japanese companies saying they'll move their headquarters from London, the likes of Nomura. Others saying they're happy to stay. Unilever, it was considering moving the headquarters to the EU. Shareholders are voting against that proposal, warning it could affect British investors with huge tax bills. So really mixed reactions to that. Now, Argo Blockchain is the first cryptocurrency mining company to be listed on the London Stock Exchange. Now, we spoke to them early this week, and we asked the company's president and indeed co-founder why he chose the LSE and why he's happy to stay.
We're quite comfortable with our decision to be in London. When we made the decision to list on the London Stock Exchange, we spent a lot of time analyzing where we wanted to build the business. London came out tops. It is the innovation capital for fintech. I think it will continue to be, and we're very happy to be building our business in London.
And this is an interesting one, because this comes back to clarity on where we are, what happens, then companies really start to make decisions on what it means for them, don't they? Yeah,
I mean, there are multifaceted reasons for every single company as to why they would locate in London, and it won't all be based on trade barriers, tax, regulation. And you have to say that for all the companies that are potentially in lobbying mode, trying to get the best deal for them, and recognising there's an awful lot of flux going on right now, there is also the potential opportunity for companies that currently domiciled outside London to come in if the UK chooses a Brexit where there is regulatory or tax arbitrage. Look at what is going on in the US at the moment. The Trump administration is trying through looking to repeal parts of Dodd-Frank financial regulation, looking at an America First strategy to try and onshore a lot of activity, make an attractive place. It's dispensing with these rules-based systems that we've lived with for 30, 40 years. The UK takes the same path, how many corporates will potentially relocate to London? So it's not a one-way trade here. It's not solely those that are looking to leave. There'll be others waiting on the wings, seeing whether it's an opportunity to arrive.
So will that balance things out in terms of what we see in the markets, do you feel, in terms of leavers and movers?
Hugely depends upon the composition of Brexit. If there is a competitive element to it, so the UK chooses competitive unilateralism on tax, on regulation, then there will be some companies for whom that does not work. They have built their business model as the UK being a platform to do a harmonised regulatory area. They will leave. And there will be others that will see that as an opportunity to domicile themselves in a place that is more competitive than it was as part of the EU. I'm not going to sit here and pretend I know which way the balance sits, but one thing I do know is the one anecdote suggesting one direction is not going to be an accurate representation. It'll be much, much more nuanced.
Mm. Okay, going back to some questions, we've still got 6 minutes, so if you want to send questions in, don't forget you can take part in the conversation, send them really easy. You can do that via Twitter using the hashtag IG4XChat. We'll put them to our guests. One question that's come in here is Theresa May, our dancing queen of Brexit. How would the pound be affected if she were to be replaced as, well, yeah, should lose her title as PM?
Unfortunately, I think the pound will probably take it quite well. Or I don't think it would go down. I mean, it depends who's going to become, who's then the favourite. If Boris Johnson's the favourite, some people in the market would hate that. If it's somebody more progressive, someone like Sajid Javid, for example. But there's no political heavyweights in the Conservative Party at the moment. There's nobody with real heft who can to come in and just say, right, I'm sorting all this like that, you know. Be like the headmaster and just sort everybody out, all the unruly kids and stuff. But I think if Theresa May went, I think there would be a period of uncertainty. Maybe the pound would suffer a little bit, but I think the market would probably take it as a slight positive.
I mean, it goes back to what you were saying earlier about the fact that people are looking for Theresa May to sort of stand up and defend, you know, the stance and defend the UK. Mm-hmm.
That's right, but I don't think actually whether Theresa May remains the UK's Prime Minister or gets replaced, that it fundamentally changes the choices the UK has to make. There are decisions. There's a decision tree ahead on whether you want to divergence or remain broad convergence. They come with benefits, they come with costs. My own view as an economist, that convergence is, in the long term, a more economically prosperous way of doing it. There'll be plenty of your viewers who will disagree with me. That's my view. But I don't think that that choice that a leader faces, the leader of a minority government in Parliament, really difficult domestic politics, really difficult choices to make with far from clear end state. I don't think that changes the trajectory on sterling.
Okay, I know this is all about Brexit and the pound, and there's so much going on with the other currencies, but there is a question about the US and the dollar. So what is your view on the US economy? Do you see further interest rate rises? I'll ask that to you, Simon, then we'll go over to Nick for the effect on the dollar.
Sure. So I do see further rate rises. I think Jerome Powell has indicated that he's quite impervious to the Trump pressure to go slower on interest rate hikes. I think they're quite happy with 125 basis point increase per quarter. That's the pace that I think is set certainly for the December meeting and then through into 2019. And you've got to remember, actually, that the Fed funds rate at 2 to 2.25%, with inflation running at a similar sort of level, we're still talking about real interest rates, after you take into account inflation, that are zero, near zero. So this is not tight monetary conditions in the US. Will they want to gradually increase that given the amount of fiscal stimulus, tax reform impact that's going to happen? Yes, I think they will. But we're not going to go back, and I can say there's a fair amount of confidence, we're not going to go back to the top of cycle levels of 5, 6, 7% that we used to under the Volcker or the Greenspan Fed. We're just not globally in that environment of high nominal rates.
So what does that mean for the dollar?
I think before we even get to the December meeting, you've got the midterms on November the 6th. I mean, this could, you know, if the Democrats get in and shove the Republicans out of the House of Representatives, Donald Trump then kind of has his hands tied, because a lot of the stuff that he wants to do, maybe if it's going to be fiscal boost 2.0, he's not going to be able to do it. So I think the dollar would be affected by that. Personally, I think the dollar is a kind of, you should never say a one-way trade, but it's a very strong currency, and it will continue to be a strong currency that you should buy on perhaps dips for the next few months.
quick, we haven't got much time, but I'm going to the risks for the euro. That's one of the questions that come in. Risk for the euro.
Risk for the euro. I mean, on the appreciation side, Jens Weidmann is a potential successor to Mario Draghi in October 2019. You know, there's some strong support in Germany to take control of the ECB, having ceded that in its last 20 years. I think that's the upside risk. The downside risk is Italy.
Yeah, Italy. And I think that even today they were saying that the new Spanish budget is being looked at quite carefully as well. So, you know, if that one happens as well, we don't know. But if that is the case, the EU is going to be fighting fires all over the place.
Okay, last comment from you in terms of what you would like to see happen in terms of Brexit and the pound over the next months.
Very clear in my mind. Once we get through when we get through the withdrawal deal and you get into the start of Q2 2019, the UK gets on the front foot in putting treaty text together on what a free trade deal looks like. We've always been responsive in the UK to what the EU has done. Let's be on the front foot, put a text out there for the EU to respond. That'll make a free trade deal come sooner rather than later.
Nick?
I totally agree with that, but I would also add that put a text for the EU to respond, but not respond by saying take it away and bring me something else, as they've been doing for the last year and a half.
Okay, well, thanks both to you, Nicholas Cawley from DailyFX and also Simon French from Panmure Gordon. Now, will Brexit influence ECB decisions next week? Join us next Thursday, the 25th, for our live show following the upcoming ECB Governing Council meeting. We'll discuss the latest announcements following the ECB monetary policy meeting. And also, what does the next year hold for emerging market currencies? Our next IG Forex chat will discuss the latest turmoil on the Asian markets and how trade wars are affecting the emerging market currencies. Join us live on the evening of the 1st of November to find out more. But for now, that's it. Thanks again to both my guests and to you for sending in all your questions.